Hi everybody, welcome back or welcome if you're new. My name is Jessica Abella. I am a tax advisor. I hope you've all been well. I have certainly had better weeks. My mom passed away about a week ago, and so today we're just going to run through what's at top of mind for me, and that is taxes after death. They say the only things that are certain in life are death and taxes, and here we are. But I get a lot of questions about my loved one passed away, now what? So here are just the tax filings that could apply. There are certainly other tasks that need to happen and other considerations, but from a tax perspective, here are some deadlines to keep in mind. So first of all, the final 1040. So they have a filing requirement for their final 1040 just as if they had been alive all year. So unless they passed away in the first couple of months and didn't have enough income to have a filing requirement, chances are they're going to have a final 1040 due April 15th, just like usual. It should include all income prior to the date they passed away. So they should still get any 1099s, their Social Security 1099 if that applies, all of those normal tax documents, they all get filed as normal. The tax return should be signed by the surviving spouse if they were married, or by their executor, personal rep, whoever was appointed by the will or by the courts to handle their final arrangements. One thing to note is that if they were married, they still file married filing joint on that last return, assuming that that's been their filing status. If they had dependent children in the household, that surviving spouse may have a special filing status those following 2 years, but that comes up pretty rarely. So in addition to the final 1040, which is reporting income before they passed away, they also may have a filing requirement for reporting income received after they passed away. So if you think about a investment account, for instance, that was in their name, dividends may be coming into that account throughout the year, and so the dividends before they passed away went on their final 1040, but the dividends that came in after they passed away and before that account was dispersed to beneficiaries go on this final or on this 1041, this estate income tax filing. This estate income tax filing is required if the estate had income of more than $600 for the year. And so again, that's usually dividends or the sale of real estate. The things that don't go on this would be things like selling the car, getting rid of the car, getting rid of furniture, those kinds of things. But collectibles, real estate, stock, any of those sorts of income would go on this. There are a couple of things to note. If the estate held on to all of the income over the calendar year, or you can elect a one-time fiscal year filing, if all the income stayed in the estate, it'll be taxed between 10 and 37% over that first $600. What normally happens, though, is that income is reported on this 1041. It says, hey, there was this much income, and IRS, here are the beneficiaries. So these two people, for instance, were the beneficiaries of this person's estate. They received 50%, for instance, each of this income, and so here, beneficiaries, you report this much income on your personal tax return, and this other beneficiary reports this other income on their personal tax return. And so the IRS doesn't get any tax from the estate itself in this instance. The tax is assessed at the personal level on the beneficiary's personal tax returns, which is normally a lower tax rate than if the estate paid the tax on it. So whenever possible, we really want to pass that income through to the beneficiaries. And in that case, the estate doesn't need to have any income held back or any funds held back because it's not going to pay any income tax. The other thing to keep in mind when talking about selling a house, for instance, is that the estate income tax return gets to use the stepped up basis, and so do the beneficiaries if property goes directly to a beneficiary. So if we're talking about real estate or we're talking about stock, the purchase price that we use when determining the taxable amount on the sale of something is the value as of the date of death. So if someone passed away January 1st, we're not using the amount that they paid for that stock or that house 20 years ago. We're using what the value was that January 1st, that date of death. So very, very important. And that usually means that when a piece of real estate is sold within a couple of months of death, usually there's not any income tax due on that transaction. But it does get reported on this 1041 filing to show the IRS that no tax was due on that transaction. The estate tax that most people are thinking of when they ask about filing estate income tax or estate tax returns is the estate tax. It goes on Form 706, and because the limit is so high, the exception is so high, we just don't run into preparation of these. So in my office, we've never prepared a 706. We refer those out if they do come up. But they're only required if your estate is valued at nearly $13 million for now. Note that that is scheduled to change in 2026 to go back down. Don't really know what that amount might be, but it's probably in the $6 or $7 million range. So definitely something to be aware of, especially with real estate going up as much as it has in recent years. But just know that for now, the limit is almost 13 million, that if your estate is under that, you do not have a filing requirement for this particular form for the estate. If you're married and your spouse passes away, it may be a good idea to file it anyway, but consult a tax advisor. Also note that states are different. They vary. Many states do not have a separate estate tax, but they do have income tax. Here in Washington state, we don't have an income tax, but we do still have an estate tax. So be aware that Washington state's estate tax limit is only 2.2 million, just under 2.2. So that kicks in pretty quickly with real estate. So take a look at what the value of your total assets are. And be aware of that. Perhaps consult an estate planning attorney, consider charitable giving. The one thing that as a tax pro I have to put out there is please don't just gift your house to your children, because as we talked about just a few minutes ago, if the house is in the estate, then that cost basis in the house steps up to the value as of the date you pass away. If you gift that to them, they are going to get your cost as their purchase price for that property. So when they sell it, they will pay tax on all of that profit, whereas leaving it in the estate allows all of that appreciation to become tax-free to them. So definitely something to plan carefully around with your tax advisor, with your estate planning attorney. Just really be mindful. Again, be mindful, consult with your tax and financial team to help make sure that you are on the right path and that your beneficiaries don't get hit with taxes that you don't intend for them to get hit with. Or the estate. I guess the tax comes out of the estate, not out of the beneficiary's pocket, but ultimately that's where it's coming from. Is there anything that I missed? Any questions? Definitely let me know. Feel free to add comments below with questions or ideas for other topics that you would like to see. And I hope that you have a wonderful week, and we'll see you back soon. Bye.